Hi everyone, welcome back to my channel. What if I told you that even in a market where the S&P 500 has hit an all-time high, gaining 26% year-to-date, there are still hidden opportunities to buy great stocks at their lowest price in a year? That's right, even when the broader market is flying, some stocks are trading near their 52-week low, and that could be where your next big win lies. In 2025, with so much hype, FOMO, and all-time highs, it can feel like the only thing left to do is chase overpriced stocks or sit on the sidelines. But what if I told you there's a smarter way to invest? In today's video, I'll show you how to sift through the noise, be patient, and still find undervalued companies. I'll also reveal an undervalued stock, so please watch through the end. Remember to drop a like and subscribe. That will really motivate me to make more videos like this. We'll break down strategies like the 52-week low, finding beaten down stocks, and using proven methods like discounted cash flow, DCF, and discounted dividends to guide your decisions. So stick around, because if history has taught us anything, it's that the faster the market rises, the harder it can fall, and we want to be prepared when that happens. Let's dive in and learn how to stay smart, stay patient, and stay ahead in 2025's market. First, let's talk about hype. Whether it's social media influencers pushing the next big thing or news outlets fanning the flames of hot IPOs, the stock market in 2025 is filled with noise. It's more important than ever to separate fact from fiction. It's easy to get caught up in the excitement, but remember, the louder the noise, the more likely the bubble. Just because a stock is trending doesn't mean it's a good investment. Some of the worst performing stocks came from the most hyped sectors, like meme stocks in 2021. Instead, focus on company fundamentals. Ask yourself, what does this business actually do? Is it profitable? Does it have a sustainable growth plan? If those answers aren't clear, steer clear. Many times the most hyped stocks end up crashing back down to reality, leaving investors who followed the herd with huge losses. In markets like this, patience is your best friend. Investors who rush in during a bull market often end up buying at inflated prices. The most successful investors know how to wait for the right opportunities. When stocks are climbing fast, it can feel like you're missing out. But remember, corrections happen, and they can happen fast. Wait for opportunities when stocks dip due to temporary market noise. Imagine you've been watching a stock for months. Suddenly, it drops 10% because of a minor earnings miss. That's your opportunity, not when it's soaring to new heights every week. For instance, think of tech companies in late 2024. Many had impressive revenue growth, but took temporary hits due to economic slowdowns. Those who were patient and didn't buy during the hype were able to get in at more reasonable prices during the pullbacks. Now, even when the market is at all-time highs, there are always stocks that are beaten down, often unfairly. One key strategy is to look for solid companies with strong fundamentals that have been punished due to short-term news. Let's look at a real-life example. Disney in 2023, Disney faced bad press over streaming losses and management changes. But the core of the business, its parks, franchises like Marvel and Star Wars, remained strong. Savvy investors who ignored the noise and looked at the long-term picture could see that Disney was undervalued and poised for recovery. Was the stock beaten down due to a temporary issue like a bad quarter or bad news? If the fundamentals remain strong, this could be a great buying opportunity. Remember, a stock's price doesn't always reflect its real value. It reflects sentiment, and sentiment can swing wildly based on short-term events. One strategy that's often overlooked in high markets is the 52-week low strategy. This involves finding stocks that are near their lowest price in the past year and analyzing whether their decline is justified. The 52-week low gives you a reference point for when a stock has been punished by the market. But don't just buy because it's at its low, look for a reason why it's down. If the issue is temporary or market-driven and the company's fundamentals are strong, this can be a great buying signal. Take a stock like Walgreens in 2024. It hit its 52-week low due to concerns over retail sales and healthcare costs, but it was still a profitable company with a strong dividend. Investors who recognized the long-term value and bought near the low were able to secure solid returns. The 52-week low strategy is about finding potential bargains, but make sure the company's core business remains intact. Now let's talk about the power of logical methods. DCF, discounted cash flow, and the discounted dividend model. These aren't flashy, but they're the key to finding out what a company is really worth. The DCF method helps you calculate the present value of future cash flows. This is a way to see through market hype and determine the real value of a company. If the stock price is below the DCF value, it's likely undervalued. Let me show you a real-world example of how to use this strategy. Let's say you want to find a stock that's been beaten up a little. You could start by searching for 52-week low stock on Google. One stock that came up in my search is Occidental Petroleum, OCY. Now we don't stop there. I went ahead and plugged Occidental numbers into my own Google Sheet, where I use a discounted cash flow DCF model to evaluate stocks. From Yahoo Finance, we get Occidental numbers, cash flows, revenue growth, and other key metrics into my Google Sheet. It turns out that Oxy is undervalued, and at today's price, it's a great buy. The current dip is a result of temporary noise, not a long-term issue. I'll put the Google Sheet link in description. Also, please check out my other video on details how DCF valuation is done. For dividend-paying stocks, use the discounted dividend model to calculate the value based on future dividends. It's especially useful in high markets where dividend yields can remain stable while prices swing wildly. These methods keep you grounded in reality, so you're not paying more than a company's worth just because of temporary price spikes. Remember, the higher and faster the market jumps, the more severe the drop can be. Using these logical methods protects you from being swept up in market hysteria. So how do you invest smartly in 2025's overheated market? Tune out the hype, be patient, look for beaten up but strong companies, and use proven strategies like the 52-week low and logical methods like DCF and discounted dividends. You don't need to follow the crowd to be successful. Sticking to solid principles will get you further in the long run. If this video gave you some insight, make sure to hit the like button and subscribe for more grounded, no-hype investing tips. And let me know in the comments, what stocks are you watching for long-term value? Thanks for watching, and as always, stay smart, stay patient, and stay invested.